Now let's bring in Ed Yardeni, president of Yardeni Research, talk about, Ed, what I guess some are calling a head-scratcher of a rally this morning. Good morning. Good to see you.
Thank you. Well,
I'm not really 15 states. I was going to say, we got 15 states with new records. We got new restrictions in Australia and Israel on COVID. Goldman's cutting their Q3 rebound forecast. Is this all about China jawboning, or is it something else?
No, I think it's to a large extent still more of the same that we started to see ever since the Fed adopted QE forever on March 23rd. You remember the week before that, they did QE4, announced that we're going to do $700 billion of Treasury and mortgage-backed security purchases. That didn't work, and within a week, by March 23rd, they came in and did QE forever, saying they would just buy Treasuries and mortgage-backed securities open-ended. And they basically started a program that I called No Asset Left Behind. They said that they were going to buy corporate bonds, including some of the lowest grade investment grade bonds that had turned into junk. And that created a tremendous pressure to rebalance out of bonds and into stocks. And so we've had a melt-up ever since March 23rd, following the meltdown that we had just prior to that. I think the bull market is still intact. I don't even view the sell-off that we had back in February and March is really a bear market. I think we're seeing maybe the tail end of this bull market with a melt-up.
So you think there's plenty left in this, on this thesis here that you have? There's more gas in this tank. How much are we into the melt-up process?
Well, if the market would take my advice and just go sideways and consolidate its gains and let earnings catch up, let the economy give us a V-shaped recovery initially, then maybe a swoosh. But I think the Fed has just poured in so much liquidity into the market. There's a potential for something that might look like 1999 all over again. Remember that Prince song about partying like it's 1999, and the market certainly has that potential.
So then, Ed, are you saying that the market is, I guess, for lack of a better word, bubblicious right now? Or given the fact that we are basically in an unprecedented scenario where the Fed and where rates are concerned, do we need to be thinking about valuations in a different way in general?
We definitely need to think about valuations very seriously. Look, what should the forward PE of the S&P 500 be when the Fed funds rate is zero, where the 10-year Treasury bond yield is under 1%, and the Fed is leaving no asset behind? They're not buying equities directly, but they don't have to. Just by keeping interest rates near zero, they're forcing a lot of people to rebalance into equities. So I think there's a potential for the PE to go still higher. I mean, in the old days, before the great virus crisis, as I call it, we all kind of agreed that the normal fair value PE was something around 15. Now we're at 22, and the question is, what's fair value? And I don't even know that concept makes sense in a market that's totally been co-opted by the central banks. So I think we could be looking at a higher PE, and that would certainly be consistent with what I call the mother of all melt-ups, which I think is the possibility here.
So, Ed, then where should investors be putting their money to work? Is it equities? And if so, are there specific places that you like better than others?
Well, at this point, if you're in the equity market, I'd stay with it. If you're a long-term investor, I'd be rooting for the market to consolidate, but it may not be that considerate. It could be a continuation of a melt-up, and along the way, I may very well recommend taking some profits. But we'll see. It's still early in the game.